Hi guys, I hope you are well. Welcome to the first lesson in the next module. And as always, what I would say before diving into this module, if you are struggling with the basics of what we have learned so far, I would 100% recommend waiting until you watch this module. Okay, so what I mean by that is if you're not on a key level of understanding liquidity, imbalance, elements to a trade setup, market structure, directional bias, time, price, that kind of thing, then go back and watch what we've learned already, what we've done already, because watching it more than once is really going to help take you to the next level. And I'm a particular reason I say it's because I'm a particular learner that has to watch something or read something more than once to actually finally get it. And that's very much inclusive of this particular skill. I had to learn this more than once until I finally understood and grasped the idea behind what it is that I'm trying to show to you guys. And it's really important that you do the same. You might be a very quick learner that you've watched it once and you just get it. And I think that would be very rare. I think what the key thing to consider is this is a situation where you're going to get the material, you're going to get the learning material, and the best way you're going to learn from it is to go away and do backtesting, go away and actually get time on the charts, because you need to gain experience, you need to understand how the market presents itself, and then once you do, and once you have that experience, that is something that can never be substituted. Okay, because experience can never be substituted. So before we go on to this lesson, and by the way, this isn't going to be a very long lesson, but I want to talk to you about what we've kind of learned so far, just a bit of a recap. So the first couple of modules on this course, depending on where you started, we've spoken about the trading business itself. So before we even looked at a chart, we spoke about the trading business, we spoke about the setup, so goal setting, daily routines, design your dreams, that kind of thing. And we spoke about your trading journal, we spoke about the trading plan, we've spoken about trading view, we've spoken about everything in regards to that. And that was before we even looked at a chart. And I would always say, watch all that first. I know it's exciting, I know you just want to look at and learn about the charts, but trust me, the mindset behind Forex trading is the hardest thing to do. The actual skill execution is on the more of the simplistic side of it. It's really 10% of your trading business, and I mean that. I cannot stress to you enough, it can take someone years. It took me years to really understand the mindset, the psychological aspects to Forex trading, and those two first modules are really key in your development for that. So when we went on to the next couple of modules, we spoke about the basics into liquidity, we spoke about candles, key areas, imbalances, fib levels, mitigation, market structure. We also went a little bit further and we spoke about internal and external ranges. We spoke about Asian range liquidity, we spoke about time, price, directional bias, identifying buying and selling opportunities. And as we went on in all those lessons, we've basically built ourselves up a foundation to start with this module here, which is really going to dive deep into the mechanical aspects of the market. So, as I say, if you're not sure and you feel like you need to go back and just learn those things, because you're gonna need those as a bit of an entry criteria before you watch this lesson and these future lessons, because it's important. So don't just start on this, basically start from the very beginning, which is all in the playlist. Okay, so anyway, without further ado, let's get started on this one, and we're going to talk today about the algorithm. Now, when you are trading, what you see in front of you is based around a certain algorithm, which basically means that price does certain things at certain times due to certain events, and it's got a few different ideas. And when you understand the algorithm, that in itself can be a serious game changer. Okay, it can be a serious game changer. And this is really what I want to try and get you guys to understand. And this isn't going to be done in just one lesson. This is going to obviously be done in a few different lessons. And as I say, we're going to go fairly deep, but not to the point where it's going to be overcomplicated. I've said this many times. There's a very simplistic approach to this, and that's what I'm going to do my best to show you guys. And it's the way I've learnt it, and all I'm doing is showing you the way I've learnt it, because for me that's the most simple way. So there's absolutely no need to overcomplicate anything, but we do go into detail. It obviously is going to require you to take notes and be engaged properly with this. So without further ado, what is the algorithm in Forex trading, or trading in general? So there's something out there called IPDA, which stands for Interbank Price Delivery Algorithm. Now, the job for IPDA is to engineer liquidity in the markets by moving price, not to be confused with buying and selling pressure. Now, what I mean by that is a lot of people think that smart money trading is based around supply, demand areas and things like that. And we talk about, there's a bit of confusion because we talk about candles, key areas, things like that. Now, yes, price comes to those areas, and yes, price mitigates into those areas, which might make some people think, or a lot of people think, that yes, it's supply and demand, but it's only going to those areas after doing certain things like taking liquidity, going to those areas at certain times of the day. It's not just purely supply and demand. So it creates old highs and lows, which is where liquidity lies. So we've spoken about this previously in the very early days, where we spoke about liquidity and where you can find liquidity in the form of relative equal highs, relative equal lows, but you can also find them in old highs and old lows. And that's where price is engineering itself to go towards, because that's where liquidity lies. So the programming logic is based on human emotion, i.e. manipulation, which we see happen a lot of the time based on high economic news calendar events. So when you see red folding news, I always talk about red folding news. When you see those things playing out and you see that the stop losses have been hit, stop losses have been run, that's because it's happening on purpose. And the logic behind it is that someone will take an obvious looking buy and they'll get taken out of it, and they won't understand why. But once you understand the algorithm and you understand that it's manipulation that's going to happen, then it makes your job a lot easier. It makes you a bit more wary of when to trade and why you're trading that certain time. So I always say, don't trade news events, don't trade Monday mornings, because that's when price is going to be very manipulative. Don't trade Friday evenings, for example, when the markets are about to close. So central banks created IPDA, which essentially means, they own the money. Retail money is the liquidity. So again, very early days, we've spoken about the fact that there's $5.5 or so trillion of money moved and engineered around the markets every single day. I would estimate that around 85 to 90% of that money is the money owned from the central banks, from IPDA. Now, retail money is the liquidity. We are in the retail section. We will always be in the retail section. We don't trade retail methods, because that's not the way we trade. We try and trade like institutions. That doesn't mean we are institutions. Institutions are trading with billions of pounds, billions of pounds. Their lot sizes are in the millions. So they've got very, very deep pockets. And we are retail. We are very, very small fish in an ocean, essentially. Now, that doesn't mean you're a retail trader. Even a smart money trader. Smart money is retail. Retail trading is retail trading. Institutional, order flow, liquidity engineering, smart money, all put together, is you're trying to mirror institutionals' thoughts, the way they trade. You're trying to do what they would do. You're trying to think like an institutional trader. So it's not to be confused by the fact that you are actually a retail trader and you always will be. So the central banks created it and they're the ones that own the money. So the job for IPDA is to deliver price to buyers and sellers in the marketplace. And price direction is decided before high impact news events. In the news event is an excuse for price to move with larger amounts of volume than usual. Now, there's a big talking point behind that statement, and I am still I'm not going by pure facts, and because no one knows which way price is going to go. No one knows, but through my own backtesting, I have seen price go in different directions through multiple different ways of price. I haven't got 30 years experience. I haven't got that kind of experience to know that certain news events will go more negative, positive, that kind of thing. But price direction is decided before that event. Whether or not FOMC is typically a negative day or not, whether or not NFP is typically a positive day or not, it's a thing that happens and is decided before the news events play out. The news event in itself is an excuse for IPDA to engineer liquidity to where it wants to take it on that particular time, which is again why I always say we're not there to trade during that news event. We wait, we give it an hour, we let the markets breathe, and then we get into the markets. So there are two functions mainly that belong to IPDA. One being rebalancing inefficient price action, and two, seeking of liquidity. So rebalancing price action, and I've got some notes here, but I'm just going to talk about this chart. As you can see, what we've got here is price expanding to the upside, and it's left price inefficiency, aka we call it imbalance. You can call it a fair value gap, imbalance. Essentially, to me, it means the same thing. Price pushes to the upside and then comes back down, rebalancing the price action before shooting to the upside again. Now we have another trip down into this area here, no doubt because there's probably liquidity, or there will be liquidity under this area here, until price aggressively expands to the upside, or it's just visiting this area of imbalance once again before aggressively moving to the upside. And as you can see, we've left another area of imbalance, and what that is there is creating another area that price will need to have the chance to come back to and actually rebalance price and efficiency to take price in its intended direction. If price decides to go high, to go lower from this area here, taking out this low, which is liquidity, which is seeking liquidity, then so be it. It would have still rebalanced in there because it would have still filled this imbalance. It just might mean that we're intending to go lower at the same time. So price moving quickly to offer price delivery. So you can see price coming in, aggressively moving down to come back to then go in its intended direction. So IPDA will seek to re-offer delivery to inefficient price areas, which we've obviously just spoken about. Okay. So seeking liquidity. Now, again, this is a very subjective market. To understand liquidity takes a lot of patience, practice, experience on the markets. You're not just going to get it in one video if you're watching it for the first time. But essentially, as we can see here, in a fairly consolidated market where price is kind of moving sideways, you can see that the price has created this liquidity here in the form of this high, relative equal high, this just here. Price expands to the upside, taking out this liquidity here, taking out liquidity to this side, before aggressively moving down to seek liquidity down to here. So we talk about liquidity being grabbed before you take a trading move. So you could quite comfortably be a seller up here, and you could quite comfortably be a buyer down here because liquidity has been taken. Now, this is a random chart. It's obviously dependent on time, price, and that kind of thing, but we're going to talk about that in future lessons and things like that. So data ranges. Now I'm going to touch base on the data ranges with you guys because this is quite a powerful tool. and it's going to be something we discuss in more detail. But essentially, what you end up having is 20 trading days of history. Now, if you use a vertical line and you mark up 20 trading days, you will see highs and lows have been taken from those 20 trading days. Once they've all been taken, you go back 40 trading days from the first area that you started. So an extra 20 trading days. And you will see more highs and more lows. And then you'll end up seeing 60 trading days. So the same thing applies, but you're just going back further and further. And now these blocks of 20 days essentially are ranges in the market which price or IPDA will engineer itself towards. It's not, well, it is interested in time from before that, so beyond the 60-day mark, but we work within these data ranges to see if we can identify highs and lows where price could be targeting for the short term. Okay, and we want to identify, and this is why I always say, look to the left. Look to the left on the market, see where there are highs, see where there are lows, and try and identify where there's an area of liquidity which price could potentially go to next. And that there will give you a bit of a head start with the way you're trying to trade, the way you're trying to move price, and the way you're trying to understand the direction of where you want to trade in that given week. So guys, that is the end of this first lesson. As I said, it was going to be a short one today. There's probably going to be a few short ones before we start going into the real price action, just to kind of speak about a couple of different things which we haven't yet spoken about, and just to get you to understand things, get you to understand the real model that we're going to go into and we're going to look for, and then we're going to go from there. So with that, I will see you on the next lesson.